The Australian government is currently doing everything it possibly can to begin to artificially stimulate the Australian economy. Now, this is completely normal, and this has been happening for hundreds of years around the world as governments use the levers and leverage that they can do to impact the markets. Now, sometimes the markets as a result go up in value when credit's easy, when interest rates are low, when things like that are happening, and sometimes markets decline when credit gets really difficult or money and monetary policy gets really tight around the world. So in today's video, I'm going to explore some of the positives and some of the negatives to what the Australian government is doing right now and what effect that is going to have on the economy over the medium term. G'day there, my name's Ben Everingham and I'm the director here at Pumped on Property. Now in today's video, I'm going to explain a little bit about what's going on right now in Australia and how you can take advantage of it over the next 5 to 7 years to put yourself and your family in a much better position. So everything I'm going to talk about today isn't my opinion. It's based on the work of Ray Dalio, the most successful investor or hedge fund manager of all time, as well as Phil Anderson and Fred Harrison's work, as well as some of the stuff that I've been reading from Warren Buffett around monetary policy. So effectively in Australia and around the world, governments through their central banks, and in America that's the Federal Bank, in Australia that's the Reserve Bank of Australia, but effectively they manipulate monetary policy which has roll-on effects throughout their economies. Now sometimes they want to see things going really well and they want to artificially stimulate things to a positive level, and sometimes when things get too hot they want to pull their levers so that they can do effectively what they did to the Sydney and Melbourne marketplaces in the last 3 years in Australia, where they make it really hard to get credit, so it takes the pressure or the bubble off the top of the marketplace. So effectively what we've got is a big lever. Now, I'm a horrible drawer, as you can see, but this is the lever. Now, on one side of the lever, we've got things that the government can do to turn the economy on. And on the other side of the lever, we've got things that the government does to turn the economy off or to slow things down when it's getting too hot or too stimulated. According to Ray Dalio, and his advice to policy makers around the world is one of the most effective things governments can do is reduce interest rates. So I'm going to talk through what governments can do, and then I'm going to explain it from an Australian perspective at the moment. Another thing that they can do to help an economy get back on its feet or to stimulate an economy during a quiet time is make credit easier. So I call that easy credit. Now we've seen this in 2009 and 10 around the world, and we're beginning to see it in different parts of the world again right now. Now they can also provide grants like first home buyer grants or like business grants or infrastructure grants to encourage the economy to pick itself back up. They can also reduce taxes. Now that's for generally ordinary people, so that's everyday people. Or they can increase taxes on the wealthy. Now obviously the wealthy do everything they possibly can to avoid taxes, and they've been doing that for hundreds of years, but they can increase taxes on the wealthy, which according to Ray Dalio, who's one of the wealthiest people in the world, isn't a good thing to do, but I wonder if there's a little bit of bias in there because of where he's coming from. They can also do what's called helicopter money. Now, helicopter money, you might remember at one point to get Australia out of the GFC, I think Kevin Rudd gave everybody in Australia something like $1,000 or $500 or $2,000, I can't really remember now. And effectively, it's like dropping money out of a helicopter. Everyone grabs a bit. Now the thing about most people is they live week to week, or they don't have a good investing or savings propensity in their life, and so this helicopter money is kind of a way of getting things started again. They drop it into the hands of people that just love spending. Those people go out and spend money. You might have also seen helicopter money through things like baby boosts and stuff like that, where effectively you're putting money in the hands of people that you know are going to go and spend it and bring it back into the economy. Now some of the things that governments around the world, because obviously if governments just continue and policymakers continue to just pump economies indefinitely, we get these big bubbles, we get overinflated asset prices, we get marketplaces that don't look balanced and therefore have a problem, kind of like where Sydney and Melbourne were at in 2016. So then policymakers also have these options to slow things down. Now, one of the things that they do to slow things down is they increase interest rates. Now, they can also make it harder to get money. So I call that hard money. Now, hard money sounds like something, it's like, why would banks make it harder, or why would people like APRA or policymakers like APRA impose guidelines that make it hard for people to access money? But when they increase the serviceability limits, when they increase the amount of deposits that people need, it can have a really, really positive effect on slowing things down. So a couple of years ago, sort of 2016, some parts of the New Zealand market, for example, were getting very hot. So overnight, the policymakers came in and said, unless you've got a 40% deposit, we're not going to lend you money to buy a property, which stopped a lot of the people that were speculating on short-term gains from getting in the market. Another thing that they did in Australia in 2015 and 16 was kind of said, unless you've got at least the 10, if not 20% deposit, we're not going to give you money. If you're not prepared to pay principal and interest, then we're going to charge you a much higher rate. They also made it harder to access money, APRA, by saying your minimum requirements, or the way that they're looking at your minimum requirements, is based on any property you currently own having a 7% principal and interest rate, which was obviously well above where current interest rates were in the market. So there's a lot of things that governments can do there to make money harder. Now, why this is so important to you is because whether governments or policymakers around the world are making it harder to get access to money or easier to get access to money, it has a massive effect on asset prices. So generally, when governments around the world are doing things like reducing rates, making credit easier, providing grants, reducing or increasing taxes, and providing helicopter money, that money flows into the marketplace. Now, it flows from the hands of people that don't know what they're doing with it to the hands of people or investors that understand what they're doing with it. And generally the money flows into the property marketplace, or it flows into the stock marketplace. Now, this can be a good thing in the short term. It can help economies get back on their feet, but effectively what you're doing through doing this sort of stuff is kicking the can down the road, creating asset bubbles that obviously can't go on forever. So this is good short term, but long term, if governments do too much of this stuff, history based on Ray Dalio's research suggests that we can get massive bubbles which end up popping. Now, the flip side of this is when monetary policy gets really, really difficult, we get declines in house prices, and we can also get declines in stock prices. Now, sometimes this is necessary to do, and you've been seeing governments around the world, for example, the American stock market has been running hot now for a long period of time. Trump was starting to increase interest rates, therefore slowing things down a little bit, but the economy isn't in as strong a position as they thought, and now it looks like they're going to start readjusting and cutting rates back down. Now, this is completely normal. This happens all of the time. Why it's important for you is that recently in Australia, the government has cut interest rates twice, literally in the last couple of months. They're basically taking into consideration some major changes to the guidelines, which is going to make credit so much easier. Now, the first stage of this is to reduce the amounts of deposits people need. They're also reducing, what was a 7% buffer. Now they're letting the banks make their own decisions. I think the next thing that's going to happen once everyone forgets about the Royal Banking Commission is they're going to roll back serviceability requirements, and they're not going to scrutinise on individuals' expenses and savings, but that will be the third step in easy credit. We're seeing grants like the 10,000 first home buyers grants just committed by the Liberal Party to start from the 1st of January 2020, which is huge. That's called bottom-up pump priming of an economy, which effectively first timers go in, they buy cheap property, Sydney, Melbourne, Brisbane, Perth, that they can afford. That starts putting pressure on property prices in those areas. The people living in those areas, like myself, back in the day, sell that property to jump into their second property. that puts pressure on the people who own their second homes. They jump into what they want, and it from the ground up stimulates the economy or the property market that way. Now, we're also doing a bit of helicopter money at the moment. For those of you who haven't yet lodged your tax returns, you're going to find that you get an extra little bit of rebate this year, somewhere around $250 to $1,000. Now, that's money that people weren't expecting, that again was brought in by the Liberal government to encourage a re-election campaign, which they won. That money for most people is just going to flow straight back into the economy. Now, in terms of taxes, they've also reduced the tax rates or increased the thresholds for a lot of the everyday people that spend their money. And then in terms of the wealthy, I don't know too much about what they're doing there at the moment, but they've just reduced the company tax rate from 30 cents to 27.5%. Now, why this is so important to understand is that all of the productive gains in society and extra money ends up in asset prices, and this is why investors always do better than people that are just saving their way or earning their way to financial freedom, because asset prices historically, in terms of the stock markets and the property markets around the world, have performed significantly better than just inflation and saving your way to freedom. So think about it this way: if all of a sudden tomorrow your wage was to increase by $1,000 a week, would you stay exactly where you are? And a lot of people would, I would. But for a lot of other people, they would increase their spending. They might go on more holidays, they might spend more money, they might rent a more expensive property in a nicer area, they might upgrade their home. And this is what happens over time. All of those little incremental increases, you know, for example, the easier credit or the lower interest rates, ends up flowing straight back into the economy. Now, one of the big things that they're doing in terms of taxes, not so much this year, but by 2024, the government has committed to anybody earning between 80 and 200K. Currently, some of those people are paying massive amounts of tax, up to 45 cents in the dollar in some instances. They're going to bring that tax rate down for people in that category to 30 cents in the dollar, which is going to take a huge amount of money away from the budget, or from the debt collecting from the government, or the income collecting, I should say. But it's going to provide a lot of people with a lot of extra money that they're not used to. And where does that money go? Straight back into asset prices. So this is why I believe the government is going to make a lot of Australians, myself included, wealthy, because all of this easy money is going to flow back into asset prices, which means we're kicking the can down the road, and in the future we will have an asset bubble or a problem. But for right now, it looks like it's going to go into land values and potentially stock markets once we come through the mid-cycle slowdown point. Now, in terms of increasing rates, I just can't see it on the horizon for Australia, and we've just come through the time of some of the hardest monetary policy we've had in the country in 50 years. So it's really, really interesting to understand this stuff. If you're more interested in it, check out Ray Dalio's book, Big Debt Crises. Check out Phil Anderson's book, The Secret Life of Real Estate and Banking. Check out Fred Harrison's work, his book Boom and Bust, or The Power in the Land. Check out Ricardo's Law on YouTube. All of those guys have been looking at this stuff for a long, long time. Ray Dalio's been doing it for 40 years. So's Fred. So has Phil Anderson. And I think we can't predict the future, but we can certainly learn from our past. Now, all of this stuff isn't going to have an immediate effect, but it will have an effect over the next 2 to 3 years. So start educating yourself, get ahead of the curve. The last thing the Australian government and governments around the world do to kick things back is start spending money on infrastructure. Now, if you look at Australia's plan, that is where we're going over the next 2 to 3 years. There's a lot of people that are underemployed or unemployed from the construction boom that we've just gone through, and the government's plan is to move us to under 4% unemployment and kicking off a shit load. Probably the biggest infrastructure boom in Australian history is about to start. Now, it might take a year to get off the ground, but all of that surplus budget, all of that extra stuff that the government's catching is going to end up in infrastructure projects so that all of those underemployed and unemployed people with skills can get jobs, and so that they can start increasing inflation a little bit according to the government reports I'm reading, and infrastructure is going to play a key part. So good luck with it all. Please subscribe to the channel. Please give me a thumbs up. For those of you interested in buying property and taking advantage of what's coming over the next 7 years, particularly in southeast Queensland, please jump over to the website www.pumpedonproperty.com, book a one-on-one strategy session with me or my brother Simon, and let's talk about where you are, where you would like to be. Let's get you fully educated on the current market and what's coming so that you can go off and do it on your own, or potentially become one of the limited number of people we work with each month through our buyer's agency. But good luck. Don't go rushing out there and buying heaps of stuff. It's certainly not that time in the cycle, but all of this stuff's happening now, which is going to make things better and also worse longer term down the road. Cheers, guys.